We haven't dealt with inflation to this degree in 35, 40 years. And so there's a lot of uncertainties and unknowns. But what I do know is that what will eventually be, call it 500 basis points of rate hikes, affects the economy in meaningful ways, granted with a lag. And the bet in my camp is that as the data continues to worsen and spreads into the first quarter, maybe even the second quarter of next year, markets are going to react, the economy is going to react. And the only debate really, well, there's two debates. When the recession starts, because there will be one, whether it's the second quarter or the third quarter, the fourth quarter remains to be seen, and how deep is that recession going to have to be in order to get the inflation out of the system along the lines that's being driven by the wage side of things, not necessarily the goods in the supply chain.
I'm only suggesting that maybe we're just, as a group of market observers, too conditioned to the history to say, okay, this is how it happens. Fed starts tightening, Fed over tightens, economy crashes, goes into recession, wash, rinse, repeat over whatever period of time we're talking about. I'm only suggesting that we had started from a much, much higher level on every metric that there is going in. Yeah, maybe the buffer is greater than we think.
I don't think maybe. I think definitely the buffer is greater than we think. And we've talked in the past about the amount of cash sitting in consumer bank accounts, that being exponentially higher than it was pre-COVID because of all the money that we distributed. And while that helped fuel the inflation, it also helped buffer the consumer and, by extension, the economy against the rate hikes that would eventually be needed to bring down the inflation. So undoubtedly, you're starting from a stronger level. But it doesn't mean that the Federal Reserve and interest rate hikes don't affect the economy in the same way that they always have and are likely to continue doing in the future.
All right, so let's look at the S&P. Let's call it 4,000, okay, for the sake of this conversation. Tom Lee today said 4,400 to 4,500 is reachable by the end of the year. Not by the end of next year, by the end of this year.
So a 10% rally in December.
Okay. Yeah. Mike Wilson says sell the rally. Sell it today because we've come a long way from the mid-October low. Which makes more sort of sense to you? He is decidedly in the bear camp. Tom Lee is decidedly in the bull camp.
So I'm going to pull a Stephanie Link and say I'm somewhere in the middle. But I feel comfortable with that.
I didn't let her get away with that either, and I'm not going to let you do that either, which seems like more plausible. Could we actually rally as much as 10% in the next 3 weeks?
I think 10% on top of the 12% that's already been realized seems excessive to me. At the same time, I think the seasonality has always worked in your favor. It's been working in your favor. This hasn't just been a tech-led rally because interest rates have pulled back. You've had consumer-facing companies like Nike, like some of the retailers that have outperformed meaningfully 2 or 3 times broad market performance. And so I think, again, the reality is somewhere in the middle that I have felt and continue to feel that the bias for the market is higher for the interim. But sometime next year, perhaps as soon as the February 1st Fed meeting, that conversation may have to change.
What if Powell signals next week that they are, in fact, near the end? If he lets us believe that you'll do what you do next week, we think 50, right? And then you start tailing off, and that they're, by virtue of that, by definition, they're closer to the end. But what if he really makes you think that inflation's rolling over, they're starting to see it in areas that were of great concern, rents and et cetera, and that they actually are closer to the finish line? That
would be incredibly positive short term for risk sentiment. There's no doubt about it. I don't think that's what he's going to do. I don't think the Fed has any incentive until you get at least until the middle of the year to give the market any clear white flags. You might interpret a white flag, so to speak, but any clear white flags on the inflation front. And let's not forget, by the end of next year, more or less, you're talking about an inflation rate somewhere between 2.5% and 3.5%, depending on how things progress from here. Even the low end of that projection, assuming I'm right with the projection, even the low end of 2.5% is above the Fed's target range, if you will. So it's not as if we're talking. There are some forecasters that have inflation coming down sub 2, but even if I'm at the low end of my forecast, you're still above. And so again, from the Fed's standpoint, you have a lot of cross currents here that are unlikely to contribute to Jay Powell being as dovish, for lack of a better word, as you suggest, as soon as the next meeting.
Okay. We're going to see, which is the best part of all that.